Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes and get ready to start your day, folks. Quick few housekeeping rules though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided is general in nature and does not take into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider whether it is appropriate for your circumstances and seek professional advice from a licensed financial advisor. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. It is based on our understanding of regulations and laws as at the publication date. As these are subject to change, you should talk to a professional advisor for the most up-to-date information. Any examples or illustrations provided are for illustrative purposes only and are not a guarantee of future performance. We do not accept any liability for any loss or damage incurred by reliance on the information provided. Any opinions expressed are subject to change without notice. Past performance is not indicative of future results, and all investments carry risks. Neither the host, guests, nor any affiliated entities accept liability for any loss or damage arising from reliance on the information provided. By listening to this podcast and viewing this presentation, you acknowledge and agree to these terms.
Good morning, everyone. I hope everyone is doing super well. Welcome to another episode of Wealth Coffee Chats with myself, Alex, from the financial planning team. So looking to add a little bit of insight into your day. I don't know how about you guys, but in Melbourne, it's a glorious day. We've had some great days and some not so great days. So good morning, Pat. Good to see you, mate. So for those who don't know, there is a bit of a time shift. So Melbourne, New South Wales, we are still on a 9 a.m. sort of start, but everywhere else, I think it's 8 o'clock. So daylight savings, we're still adjusting. So some people ask me why I wasn't on, but it was an hour later. So here we are, guys. So let's get into today. So what I want to chat to you about is really continuation from last week about the inflation. And, we got our announcement on Tuesday, Melbourne Cup Day. So 2:30 p.m. As expected, the RBA announced a hold on the cash rate. So what I want to do is, and I got some really decent feedback on this, is that going through the RBA sort of minutes and their announcement is something that you guys want to hear. So maybe we'll keep this as a bit of a once a month, an update, go through the statement, see what they say, and just highlight some key parts of the announcement. So let me just share my screen, something I've prepared earlier. So let me see. All right, you guys can see that. Awesome. Right, you don't need to see me. It's all good. Let's go through the announcement. So as we saw last week, the inflation creeped up a bit. But what they are starting with, this message, is that they're essentially saying that overall the inflation has fallen since the 22 peak, and they're kind of taking the credit for the increased interest rates that led to this sort of decrease in inflation. However, looking at the recent data, they're saying that the inflation rose sharply to 3.2%. That's the headline inflation, which is essentially the change in the shorter term, as opposed to the trim mean inflation, which we spoke about last week, which is a little bit over a longer period of time. So, someone said they can't see me. All right, let me see if I can get myself into here somewhere. Oh, here we go. Yeah, I'm here, guys. It's me. All right. So, and as expected, right? So we spoke about this a few times now in the past. They're kind of citing the fact that the electricity rebates in a few states are coming to an end, which finished end of October, right? So essentially, this means that the inflation figures moving forward will likely have a more traditional reflection in this area that contributes to overall inflation. They're talking about various factors there that contributed to that, but ultimately, they're saying that the central forecast in November, which is based on technical assumption, which means that they don't know what's going to happen for one more cut rate in 2026. So essentially, they're trying to say that there's likely going to be no more cuts for the rest of the year, given the numbers. And you'll see at the end, they're citing the fact that they need to look at the data before making any decisions. So moving on, they typically go through domestic and international sort of outlook. So we've got, they go to say there's a pickup in private demand evident in the June quarter, is ongoing. House market is continuing to strengthen and house prices are rising. Well, we know all of that, right? And I was looking at the ABS data and to sort of put some numbers behind it. So we know that the demand is high and that the supply is nowhere near where it should be in terms of the target numbers. So then you look at the opposite scale. Well, who's coming in? So we've had about just around 430,000 new migrants coming into Australia since the start of the year. So really, we're about 10 months into the year, so into our 11th. So there's still a couple of months to go, and we're already at a decent increase in population. So historically, that intake has been about 200,000 to 300,000 yearly, but now we are sitting at more like 500,000. So I think by the end of the year, we might be hitting those numbers. So that's been probably one of the drivers, because the migrants are coming in, they have to live somewhere. They either have to rent. Typically, you probably would have heard from other guys on the podcast. The first couple of years, it's all about the adjustment. Where do we live? Get the deposit, get the financials sorted before applying for a loan. And 2 years after that, you're looking at an entry into the housing market. So from that perspective, everyone knows that at the moment the housing situation is very scarce, which drives the price. So the other area to look at is the labour market, and typically what happens is if the inflation is high, then they tend to increase the interest rates, and the labour market is low, then that's a perfect mix. However, when you have a labour market that is also coming in at a very high rate. So you can see that, we reported on this, about 3 weeks ago. The unemployment rate has gone up to 4.5%, which was higher than they expected. So if you start to increase interest rates into high unemployment, then that could create a bit of an issue. So at the moment, it's a bit of a tag war between the two, inflation and the unemployment rate. So on the back of the hold, they're still citing the fact that the companies or businesses are struggling to take on new employees on the back of high interest rates, which means that for the business owners, it costs a little bit more to run the business, and the wages are higher. The productivity is still a large sort of factor. They suggest that the productivity is weak, which it's been a bit of a hot topic over the last 12 to 24 months. So that's something that is not being solved quick enough. Again, the typical words that they say in here: uncertainty about the domestic and even international outlook as well, further down when we get to the international side. So the same language over the last little while now. So you'll see that if you read these, as they come out on yearly basis, monthly or bi-monthly basis, you'll see that the language stays the same, and the message is typically, we don't know where things will go. We need to look at the data. There's some uncertainty around domestic and international geopolitical events that can threaten the decision for next term. So again, same story, nothing really new in this section here. So one thing they mention here is around uncertainty regarding the assessment that the monetary policy remains a little restrictive, the lag in the effect of recent monetary easing. So I don't know if you know, but in the US, for example, they are going on another QE run, which means that they're going to be printing money into 2026, right? So which means that the inflation will likely get heated again in the US, which may then come across onto our shores as well. So watch that space. We spoke about cash and inflation last week. So if you want, go back and listen to that and the impacts that this may have on just staying and keeping cash on the sidelines. So what do we got? So again, their main message is maintaining price stability and full employment is the RBA's priority. So typically that's the mandate. Again, the inflation is tricking onto the higher band between 2% and 3%. So that's an issue. They want to try to restrict that if possible. So they're going to say that it will take some time to see full effects of early cash rate reductions, which means that they haven't fully seen the impact of the drops over the last 10 months coming through into the economy, and they're kind of they've got someone to blame, typically inflation, right? So but again, if you've got subsidies around electricity, other things that fudge the numbers essentially, then then that's an issue, right? So you kind of have a false economy there and false reporting. So whilst that's good for short term, long term, everyone will know what it looks like. So we've got Tim here. So what do we got? High inflation rate as in above 3%. The Reserve Bank might actually raise rates again in 2026. Maybe not, Tim. And again, that comes down. I think the unemployment numbers will be super important to pay attention to, because that will determine where things are traveling. Because if the unemployment rate is high and inflation is high, I'd argue that they'll most likely hold and try to manage the unemployment rate for the time being. And before they go and increase rates again, it'll be damaging to the economy for sure. Because if you look around the globe, everyone is reducing their interest rates now as well. So, and look again, the sort of citing that again, uncertainty about the outlook in both directions. So, which means that they don't really know. They're really relying on the data set they're relying on the data set to make the decisions, essentially. Nothing else beyond that. So, what should you do in this instance? Again, we spoke about it last week. Hard assets typically do quite well in this environment. Cash, it's a very difficult time to remain in cash because you've got all this inflationary eroding effects that are happening. You look at the prices, which they're sort of mentioned in the statement. The prices are rising, which means that your dollar is losing value. So by having that in other assets that can appreciate in value, you are likely to be in line or above the inflation rate with those assets. But obviously that creates a bit of risk within your asset base as well. So you want to be careful around there. Tim, absolutely. It's better to hold at the moment than it is to raise the interest rates. So look, ideally, 2026 will give us a little bit more clarity. They'll probably look at reducing one more time before having a decent pause in the market, I would say. So the market is pricing that in as well. So a lot of people are expecting the interest rate drop. So 25 basis points isn't a lot. And it shouldn't really affect your strategy or your investment strategy around whatever you do. It should just be a small bonus, but ultimately you should be investing for a longer term with a significant amount of buffer, 2-3% buffer, so that if the interest rates do go up for whatever reason, then you've got all bases covered and you can hold on through those tough periods. If they're tough, they might not be tough. So again, it's quite good for the fixed interest side, so the bonds and things like that. So that means that if you're on the defensive side, you will receive a higher yield or interest return for a little bit longer. So what do we got here, Tim? Government low deposit 5% will drive property prices upwards already. Yeah, absolutely, mate. I covered this off a couple of weeks ago in one of the strategies that I think would be great for first home buyers. So absolutely, the 5% deposit is driving that up. However, the other side to this coin is being able to support that purchase as well, right? Because ultimately you're going to have a much higher loan. So you want to be able to afford that and not spend 90% of your income on that. Look, guys, hopefully this helped you out, and you got an up-to-date as to what is going on from the RBA side. So hopefully that gives you food for thought, and we'll see you guys next week. See you later. Bye.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.